So we are now going to go to the part that I know that people like to talk about, and it's the pillar of investment. So this gets a bit more technical than the previous pillars, and we're gonna get into some numbers. It's gonna get fun. So if you were bored by the first part of the conversation, the second part is gonna get the logical side of your brain on. So the first concept that's very important to understand when talking about investments, any type of investment, is the idea of compound interest. So there's like a concept in finance that just it's simply put, it just implies that instead of, for example, getting the gains just on the amount that you have from this year, you reinvest that amount, and that rolls into the next one and the next one and the next one. So when you do stuff in life, it always rolls out into the next and next and next, and then it compounds. This, we're gonna talk about money. So in this case, I'm going to give you some hands-on education, actually. So we're gonna go to one of my favorite sites, which is called Investment Calculator, and I'm gonna give you some examples of some really simple examples of what compound interest can do. I'm gonna zoom in if it's too. There we go. Okay, so compound interest implies that, let's say you start with $100, and let's say that each year that 100 increases by 10%, right? And that doesn't sound too exciting. That's like, or let's say 1,000, sure. Each year it increases for 10%. And let's say we do that for like 2 years. You're gonna just see what you would expect to see. It increased 2 times by like 200. You're gonna get 1,200. It's not too exciting, right? But then imagine if instead of waiting for 2 years, you waited for 20 years. So now it increased from like 1,000 to 7,000, right? In the span of 20 years. Now that's a long time. That's fair. Well, let's give it like 30 years, right? Let's give it 10 more years. Now it went from like 7,000 to 20,000. That's like from 1,000, right? Now this is just like some illusionary examples. Can you get like a 10% year over year return? Maybe not. But this is just to like demonstrate the power of compound interest. So the more important thing I want you to think about is, if there is a vehicle that gives you 10% year over year, and we're going to discuss that later, is it gonna be worth it for you today to spend like 100 euros on something if you know that that's gonna be like 2,000 euros in 30 years? Now 30 years is a long time, but maybe it's worth it, maybe it's not. Another thing also is to just give you an example of, this is like a standard one that people show, is because if you start working and you work for 45 years, and out of each paycheck you like split 100 euros every month and you invest it for 45 years, you're gonna be a millionaire. This is just like a famous example. If you didn't have a compound interest, that turns you from 54,000 to a million. Now there's like problems with this calculation. We're gonna talk about it. There's many problems. The main one is inflation. That's not really a million, but that's like the general gist of it. This is how you hook people on compound interest. This is what you show them. And also a fun thing, we're gonna talk about this when we talk about proper and real investments, because this is just like a hypothetical scenario. The important thing to understand is that the longer the time horizon you have, the more time the money and other efforts in life, but let's talk about money now, have the opportunity to grow, and not just grow. Their growings get to grow. On 10% a year, that means that every 7 years, your initial investment doubles. So if you just leave it 0, yeah, every 7 years, your initial investment doubles. Well, that's the concept of compound interest. It applies to other areas of life. It usually applies in effort. So sometimes you're gonna apply twice the amount of effort and get like multiples and multiples of the result. This is why important. This is why it's important for you to invest. Keep in mind as well that how this compound interest works in one direction, it also works in the other. So if you get into really bad debt, the compound interest is going to work against you, the same way it works for you here. That's the whole pillar. The second is the concept of diversification. Diversification doesn't mean nothing complicated. So first of all, I want to explain to you how we value a company, and this can be applied then to other stuff than companies. But let's start with a company, and let's start with a simple business that's a flower shop. Now this is outrageously simplified. This is how I imagined like evaluating a company in under a minute as a challenge. So I wanted to explain to you how we evaluate a company in like a really short time frame. So imagine you had a business of selling flowers, and in your inventory you had like 5 flowers worth like 20 euros, and you have equipment worth 100 euros, and someone offered to buy that business for 130 euros. Now would you sell it? Even though like this is like an offer that he offers you more money than you have in actual assets, is it worthwhile? Like, is it a good investment? How do you value your company? So maybe you should sell it. Well, what if I told you that this like flower business basically makes you 200 euros every year, right? Then what's the evaluation of this business? What do we do with it? Well, the simple answer is that if you want to sell it, you want to replace it with the amount of money that can generate the same income for you from a bank or from some safe investment, right? And let's say that bank would give you like a 10% savings account, which will not happen, but let's say that happens. Then you can sell your business for like 2,000 euros, because if they give you like a 10% savings account, that means if you put this to 2,000 euros, you replaced essentially your part. And you sold your business for like something that's of equivalent value. This is what we call a 10 what do you call it? Profit per earnings value, PE. That might not be the shortcut, but this is like a 10 PE ratio. That means it takes you your business is valued 10 times the multiple of what it made in a year. This is like isolated, like crazy case. In real world, when you evaluate a company, you don't only account in for this, for like you account for value in terms of, is the market growing? Is the next year going to be better than this one? Is going to be worse? How what's the risks of this company? Does it have like a very like tricky CEO that's gonna get drunk someday and do something stupid? Does it have like what are the very specific risks of this company? Is this company at the peak? Is it just started to rising? Is it emerging? And so on and so forth. So evaluating a company in real life is much more difficult, and sometimes you're gonna see some cases, some specific cases that I want to show you today. And we're going to go to another little example. So we're going to look up a random company, let's say Microsoft. And if you look at its PE, it's easiest to look at the PE. That means that when you buy stock in this company, it's going to basically take 36 years for your investment to return. So you remember how earlier we were talking about how it's going to take us 10 years for our flower shop example. In this case, it's going to take you 36, you count in the price, 36 years of profit for Microsoft. And you might think, well, that's pretty crazy to buy Microsoft at that valuation. Well, we can look for some other, stocks. So we can look, for example, for an AMD stock, and you will notice that if you buy actions of the stock, it's gonna take you about 1,000 years. It's gonna take you about 1,000 years for it to return. So you might ask yourself, well, who is buying the actions of this stock? Like, they're not gonna be alive. Their great grandchildren are not gonna be alive for it to turn profitable. Well, the idea when buying a stock like AMD is that you don't expect the stock to produce the same results this year and the next and for the next 1,000 years. You expect it to grow quite significantly, evidently. So if you would expect this stock to like grow 5x, 10x, then this time frame every year, like you expect it to grow like 10x, then next year it's just going to be 100 years, and then next year it's just going to be 10 years, and then that's like your hope with the evaluation you're buying it today. So the fun part, as you can see, like evaluating stocks is quite complex. I'm not gonna go like deeper than this. I think this is a good like intro, giving you just enough so that you kind of get the idea. But when you buy a stock, what you are technically betting, so you are, unless you're expecting it to stay the same price, and just like waiting the 36 years for Microsoft or whatever, this is alpha. I know it's just written A because I couldn't be bothered to find alpha on the keyboard, but a professional term is called alpha. And what you're trying to do when you're buying a stock is to presume that there is some alpha, there is some value that you see in the stock that's not accounted for in the actual stock. This means that you think that currently buying the stock, it's undervalued, right? And we just discussed how in the stock we already priced in the next 1,000 years or whatever. It's already the growth of the stock, the circumstances of the stock, everything like that is, let's say, already incorporated in the price. It's already priced in, and markets are very efficient, depending on the market, of course, into incorporating and figuring out this. So for you to say that you have some alpha is a very bold statement. And either you're just like gambling and buying a stock, or if you believe that you are actually searching for the alpha, you're not gonna have much fun, because the reality is that no matter how much you try, you want, no one really knows where the stock goes. This is a quote from Wolf of Wall Street. Not even Warren Buffett, the legendary investor, knows where the stock will go, right? So, to further prove this point, because people want to be day traders, there's been a lot of studies done. This first one says that when you are trading as a day trader, in 97% of the time you lose money over a period of 300 days. I read this study specifically. There were like 5,000 traders. Only one of them beat the market. So that is like a true statistic. That's a newer one. That's from like 2015. That's like the newest one that we have. An older study like found that about 5% of the traders were profitable. This is on a period of 2 years. I don't know if we tested them for a longer period if they would be profitable, right? And there are much more statistics that are going to show you that picking stocks and trying to figure out which one is the good time to buy and which one is not in a good time to buy is kind of always a losing game. So, what's the way to predict the stock? Well, it's to cheat. Basically, if you want to know where the stock goes, the only reliable way to do so is to be high up in that company and have some insider information that public actually doesn't have. So that's your edge. Of course, this is illegal. So what you want to do here is, if you are in a high position, then you don't buy the stocks. You tell your nephew to buy the stocks or something, because he's not tied to the company. But regardless, if you don't have that ability, if you're not a high executive in these like big corporations, then you can be a part of a team of quantitative researchers who are very, very cracked. Those are like people who you saw at math Olympiads and stuff like that, and then at top schools, and the best trading firms pick them and then put them all together in a room, and then for a year straight they're trying to find the alpha, and then they find like a slightest edge in the market, like a 0.01% difference in the price, and then they throw like millions at it and exploit that alpha, and then they move on. So that's like the other way of predicting or like finding value in picking stocks reliably. Well, you might be quite discouraged at this point and ask me what what should we do then? Like, why even invest money? Why even do any of this? Like, what's the point if it's so grim? Well, what we do is we diversify. So the idea is that we will not invest in a single stock. Instead, we are gonna invest in something called an index fund. An index fund is just a basket of stocks. So instead of buying like a singular stock, you buy a collection. You buy a dozen, 100, 1,000, based on a sector, based on a region, and any other aspect. You can buy stocks sorted in any way you want. And there's like many examples of these different like indexes. Some follow like American market, some follow like NASDAQ, some follow the total market, the everything that's going on. Some follow just like healthcare companies. Other are going to be like a very, very specific. You can pick and choose any of these. And then how do you evaluate which one you invest in is basically, again, your kind of belief that the market is gonna overperform the other markets. And also, like, you're gonna get all the money that all the day traders are losing. So it's kind of like, since trading is kind of a zero-sum game, meaning that for you to get money, someone needs to lose money. And we saw a lot of people are trying to pick stocks, so a lot of people are losing money. So if you're just patient and invest in something safe long-term, usually tend to make money. Of course, like, this is not, anything's not guaranteed. There's risk involved here, but diversification, for example, instead of buying Microsoft, you buy NASDAQ 100, which is the top 100, not really tech stocks, but you can imagine it that way. Top 100 tech stocks, kinda. And instead of like being reliant on Microsoft's performance, you're reliant on the whole sector. And if Microsoft suddenly bankrupts, you're not going to be out of money. But on the other hand, if Microsoft has some crazy new AI and they explode, you're also going to be like lower returns on your end. But it's a risk management strategy, so it like makes your risks a lot lower, but also your returns. We want to check out this like cool site that I don't like. That I do like, sorry. And it's a site used for backtests. It's very nice. You can see like different indexes. You can make your portfolios and see how they performed over the past period. Now I wrote down the important important disclaimer here, but basically we're gonna look at some past results, and they do not predict anything close to like future earnings. And it's very hard for people to grasp that, because people see a graph going up and they think graph is going to continue to go up. It's like a human nature thing. It's very hard to imagine that if graph goes all the time this way and then one day it just decides to go the other way. That's like, but that does happen. And we need to be aware of that. So we're going to look at some famous indexes. So for example, this is a all world index. I think it contains like 3,700 stocks. This is an index for just an American market. We can look at, for example, I'm going to give that because I did that as an experiment. We can look at the NASDAQ. If it wants to work. Anyhow, until that saves, I'm going to show you some other ones. So this is like a world index. This is like a safe bet. People like to put money here. Basically, as long as the world's economy grows, you're getting money. And usually when world's economy is on a decline and this index loses value, usually your life expenses are also like getting lowered. So this kind of tends to be like a safe choice for people. And we can look at some, for example, returns. I want you to notice the like 8% return of the world index here, and we're gonna believe it for now. This is like an absolute value. So if we looked at the compound, we looked at the compound interest earlier. We know that 8% is quite decent. This does not account inflation. We're gonna talk about that later, but you'll see that over time. This is how this is like index adjusted for inflation here. but we're going to talk about that later. So this index, you have different analysis. Ones that looks cool here is how long did you have to be invested in the index in the past period so that it doesn't return negative value or less than you put in. And it turns out that every time you put it in for 10 years, it was always positive. So the worry with stock investment in general is that it's volatile. One year it's going to go quite down, the other year is going to go quite up. The risk is usually associated with volatility, meaning that the more you see the graph moving up and down, that implies more uncertainty in people evaluating the stock. That implies that the stock is more risky. But you see that over the long run, even when the index falls, it tends to come back up. Now this is not a guarantee, of course, but and again, this is like 8% return. If you include inflation, it's like 5.66% return. The other one that we look at that's quite famous one is the S&P 500. It's the top 500 stocks in the American market. It has like 10.27% growth rate. If you include inflation, I think it's around 8%. And again, like this is very volatile. You'll see it year by year. 1 year it raises 20%, the other year it falls. The other year it's like 41%, then it's minus 34. It's not stable. If you're putting your money there for a year or two, you're not gonna find good luck. But you can see that you know, these are different types of investments you can think about. Now I don't want you to focus too hard on this number specifically, because we can look at in some cases we can look at. I'm gonna give you like a good example. We're gonna look at Bitcoin, sure. And if we were just to evaluate the average return rate or year over year, you're gonna see that Bitcoin is quite good. And you would be forgiven to think that Bitcoin is a good investment. So you can see this volatility. It looks quite. I would agree. It looks interesting. But even here, like if you look at an average yearly return, it's quite nice. Like you double your money every year on average. So that doesn't sound too bad, right? Yeah, there's, and I'm not gonna bore you with, I wanted to explain you the Sharpe ratio. There's no need. So just looking at these returns is always, is not a good thing to do. It's a recipe for disaster. That's why, apart from diversification that we just talked about, we have more topics. So the last topic here that we want to talk about is risk. So when investing, I was just going through examples of like stocks. You can imagine that real estate, when you're buying a house, or other types of investments, even when you invest in your own skills, they all come with a degree of risk. And what I want to teach you today is that risk is a necessity, meaning that you can't really do anything worthwhile in life without risk. That includes gaining like a good return in the stock market, unfortunately. So humans, by default, are wired hardly against risk. This is why, because the risk-averse humans were the ones that survived over the years. The ones that were not so risk-averse, well, they did not really survive. So we have been naturally selected to be risk-averse. We don't like risk. We don't like risky things. We're going to pay a substantial amount of money just to not have the uncertainty, right? But if we don't participate in this risk, we then participate in another type of risk, which is we just don't hit our goals. The money gets eaten away, or we're investing too safely and we're not reaching what we want to reach. So usually with stocks, this is what I mentioned earlier, volatility is associated with risk, meaning that the more the stock moves rapidly, you'll see two stocks that have the exact same like initial value and the exact same end value, the green stock and the orange stock. And you'll see that the orange one we evaluate as much more risky than the green one. because it has an intensely higher volatility, implying that investors again are not certain of its value and are more questioning it. While when we see like a more less volatile, I guess, stock, we associate that with lower risk because it's bigger likelihood that it's properly evaluated. But if you're investing long term, if you're investing in something you believe in and you're putting your money and you're keeping there for 10, 20, 30 years or whatever, you kind of don't care about the current volatility, right? Because it doesn't matter for you if today like a stock drops 3% or gains 3%. It's not like a relevant thing to you terribly. Of course, it's not something to be ignored, but yeah, that's just a mentioned thing. So there's two types of risks with every stock. There's an asset-specific risk and a market-specific risk, right? An asset-specific risks we avoid by having diversification. This is the risk of a singular company, like a tech company, having like a scandal, having something horrible happen, or just like defaulting on their loans, like bankrupting or something like that. This is like risks that you are exposing yourself if you're not properly diversified. But if you diversify yourself, you're kind of mitigating this one risk. The other risk that we want to talk about is a market-specific risk. So if the whole tech space is in shambles, then all the tech stocks like fall. And you can be the best of the tech stocks and you're still going to fall because the whole market is falling. We can't really predict or handle this risk as easily as asset-specific risk. That's why there's like a huge thing in the brackets here. It doesn't really help too much. So usually we tend to deal better with market-specific risks by increasing our risk tolerance. Because these types of risks tend to be short in nature and usually last like a couple of years if there's a recession. Usually is also like an important word. It's not a guarantee that the stock will ever return, even the whole like market indexes. Like if the whole index doesn't recover, like imagine investing in like horse transport, like I don't know if that was an index, but like 100 years ago, and it never came back, right? I have a better example actually. Imagine investing in like Japanese stock market when it was like a leading stock market back in the day, and it then dropped and it never really recovered. So again, we want to talk about the risk tolerance now. That mentioned like increasing your risk tolerance. There's like two parts of risk tolerance. One is purely emotional, and those emotions are often guided by like financial literacy. So people who are not really financially literate might not have strong emotions, not because they're less risk averse. It's just because they simply don't know better. But there's like two parts, so the willingness part and then the actual ability to bear the risk. So what does that mean? How much money is on that stock? Can you handle losing your money? Is it a big deal? Is it not a big deal? How long of a time horizon you have? If you're very young and you can wait for a stock to return for like 3, 4, 5 years, then you have obviously like your risk tolerance is a lot higher, and also like your expected income. It's not, if you can recover more easily, then of course the risk is not as high. It's okay that as the time changes, as you change, as you get older, you have less of a time horizon to wait. You can adjust your exposure to risk. When we like have a portfolio and we want to adjust our exposure to risk, we tend to move either to like more, like if you're younger, if you're me, I have like in my portfolio like some single stocks. I have some rather risky ventures, right? Not majority of my portfolio, but there is something that's rather risky, and I can do that because I know I can handle it. There's like risk tolerance there, and as I get older, as my portfolio grows, the more and more I'll probably move towards safer investments and slowly but surely like move to like stuff that's very like a world index or a bond or something that's very safe and very, very tolerable. And finally, risk is necessary. This is the one thing that I started with. So it's like a thing that you kind of need to deal in life. When you choose a career field in the beginning, some career fields, you basically put a bet, like I'm gonna go to school for like 4 years, and then after that there's going to be a job for me probably. And that's a bet. That's a bet you made, and maybe in 5 years there's like no need for your type of role. Maybe there is. Now, is that bet more or less risky? Depends on like the field you're going into. Sometimes the risk is bigger or lower. When you're buying real estate, the similar things apply. People like buying houses, like buying real estate. The real estate is a bit of a different beast because it's quite local. So there's like more market inefficiencies. Potentially, like properties are not as nicely and precisely priced in as you would expect on a global market. So that makes like real estate, like I can be tolerable to people who tell me that they can pick a really good like undervalued piece of real estate and then they can buy it. Like that's probably a skill that you can like exploit because the markets are very local and probably not as optimized as something like a global market is. Also, again, you need to find like your balance, where your risk tolerance lies. What do you want to risk? What do you not want to risk? Do you, like we saw compound interest earlier, we're going to talk about it a bit more when we analyze debt, but we saw like differences between 8 and 10%, and it's quite a significant difference. And is it worth the risk? For example, having like a fully US stock and relying on US market compared to like the world market. Is it worth the risk of the US economy falling behind the world's economy? Common wisdom says it's worth the risk. Research says it's not. Usually like over the long time, over like tens of years, usually like just the world index or some as broad of a fund as you can get usually overperforms it over the long horizon, right? But again, the problem with all of this is that markets are ever changing, never predictable. You cannot really expect what's going to happen. That was the pillar of investing. It's a lot more hands-on, a lot more numbers. I tried to like give the higher level overview, not to go too deep into any of it. So I hope people who know about it are still still gave you something new, and people who didn't know about it are not overwhelmed.